Welcome everyone, and thank you for joining us today for our presentation on trust distribution considerations. My name is Alexis Kokinos and I'm a tax partner at Pitcher Partners. I head up the National Tax Group at Pitcher Partners. I'm the chair of the CPA Tax Technical Committee, member of the ATO's National Tax Liaison Group. So me and my national tax team have been heavily involved in ATO consultation on trusts and a number of the items we're discussing today. So today we're going to talk about trust distribution considerations, and we're going to go through a number of considerations, both commercial and tax considerations that you need to have for your 30 June 2023 distributions. So what are we talking about today? So this presentation specifically is on your year-end trust distribution considerations and some of the key issues that we think you need to manage for this 30 June 2023. We're going to outline what we believe to be a pathway or a prudent way of tackling trust distributions for this year. Now, you might be asking, why is this different, or why is this more important this year as compared to prior years? And in essence, what we're saying is probably not very much different to what we've said in prior presentations or in prior years on trust distributions. However, there have been some very heightened risks recently around trust distributions, both from a commercial as well as an ATO perspective. There have been quite a number of tax cases and significant ATO activity over 2022 and 2023 that have really highlighted the responsibility of trustees and that responsibility in respect of their administration of trusts. It's really important, therefore, that trustees be aware of processes that can mitigate some of those risks and evidence that they've properly considered these key issues. From an ATO review and compliance perspective, the ATO have been very successful in litigating against trust distributions where there's been tax benefits provided. And we're going to talk to a number of those cases through this presentation so that you're aware of them. Importantly, now the ATO have issued guidance on what they call trust reimbursement agreements, where they could seek to argue that the trustee is assessed on a trust distribution that it's made to a beneficiary. Now, the guidance applies from 1 July 2022, and thus it's really critical that trustees are able to comply with this guidance as best as possible for your 30 June 2023 distributions. The ATO has also obtained funding in the last budget for 1,200 new persons in their task force, which includes coverage of the private wealth space, and they definitely will be targeting trust distributions and trust anti-avoidance provisions through their reviews. So significantly more scrutiny will occur by the ATO on trust distributions going forward, and everyone needs to be aware of that when planning for 30 June 2023. In addition to tax scrutiny, there's been recent decisions such as Owi's case that provide a timely reminder of responsibilities that trustees have when making trust distribution decisions. Now, Owi's case, I won't go through that in any detail. It's not a tax case. It did involve a trustee that, when making its distributions, was held not to have had real and genuine consideration for the beneficiaries of the trust when distributing the income for a number of years. Now, that case involved a beneficiary that had special needs, and the trustee did not distribute to that beneficiary. The court believed that the trustee should have had appropriate consideration of the beneficiary when making distributions as part of the distribution process, which couldn't be evidenced. Now, while the actual distributions were not made void in that case, the case resulted in remedies being made to the beneficiary that wasn't considered as a part of that distribution process. So it does highlight that evidencing that you've had proper consideration of all the beneficiaries is something trustees need to demonstrate and should encapsulate in your year-end distribution process. So taking all that into account, trustees need to absolutely understand the obligations, and that trusts aren't there simply just to minimize tax liabilities. So taking into account Owi's case and ATO scrutiny, we believe it's important that your trust distribution process covers at least three important points coming to 30 June and post 30 June. First is understanding roles and responsibilities as part of the distribution process. Now, where you operate a trust, distribution decisions ultimately lie with the trustee, and these cases highlight that fact. The trustee needs to properly understand the purpose of trust, who the trust was established for, who's the beneficiary of the trust, if any beneficiaries have special needs, to have real and genuine consideration of these matters, and to make the ultimate decision on distributions based on all the information. Now, many of these items will absolutely require assistance from your legal advisors and your tax advisors, so trustees will need to reach out to understand these items. Now, taking into account Howie's case, the trustee doesn't necessarily need to document the reason it's making distributions, but it should evidence that it's had real and genuine consideration. So therefore, it's recommended that at the very least, trustees should go through a checklist with their advisors, ensure that they've checked the trustee, considered beneficiaries, considered special needs, before finalising any distribution decision. As a part of the year-end process, in addition to that, trustees may require assistance determining what to distribute and who to distribute for the income year. Trustee will probably need to still forecast all of its financial information and tax positions and understand the consequences of making distributions to various beneficiaries of the trust. Taking that into account and also considering the point before in relation to OWIs, the trustee will then come to a conclusion as to what distributions to make and then would have to make those resolutions. Generally speaking, those resolutions have to be made by 30 June or an earlier time as required by the trustee. And it's really important to document the final decision made, not the reasons, but the final decision made and evidence that you've gone through the process. Post 30 June, once distribution has been finalised, one key item that comes out of the ATO guidance on reimbursement agreements is that there will be greater scrutiny on how distributions are being settled. The ATO are likely to focus more on cases where beneficiaries don't receive their entitlements or are not made aware of those entitlements. In those cases, the ATO are very likely to argue or try to invalidate such distributions under a number of provisions, which I'll talk to. So through the process, it's really important and really critical to ensure that distributions are real. They're going to be there and used to benefit the beneficiaries that are receiving distributions. Trustees can quantify unpaid amounts for all beneficiaries. Trustees understand how those amounts will be applied for the benefit of beneficiaries, and the trustees notify beneficiaries of the entitlements and amounts unpaid. Now, a lot of these processes are mandated in the ATO guidance material, and they'll be checking through these things when they review or consider Section 100A or reimbursement agreements, which we'll discuss a little bit later. So that's a really critical process that we're saying that all trustees need to have regard to or try to follow as best as possible for this 30 June when coming up with their trust distributions. One key thing, and probably the key thing to understand as part of your distribution process is effectively what is required to make an effective distribution from the trust. Now, the annual distribution of the income of the trust generally drives who is taxed on the taxable income of the trust. And therefore, going through the trust deed is really important to understand what is required to make an effective distribution of that income to the intended beneficiary. Before you get to any anti-avoidance provisions, and when you have disputes with beneficiaries, the first thing that is ever looked at is whether the distributions are effective at law. One of the first things that are considered as part of this process is whether the beneficiary is really an actual beneficiary of the trust. And in a lot of cases, when you examine the trust deed, certain beneficiaries may not qualify as being a beneficiary, or we've referred to the wrong beneficiary in distribution minutes. If the beneficiary is not eligible, then this can result in the distribution being squashed. In some cases, examining even just the trust deed itself can identify the trust may have vested, and therefore the trust may not even be valid and may not be able to give effect to intended distributions. The second thing that's really important to understand is the amount of the distribution and whether that's correct. Now, many trust deeds have different definitions of what is the income of the trust estate, and almost all trust deeds that I've ever examined don't have exactly the same definition. By way of example, a trust deed may require an amount equal to taxable income to be distributed, yet the trust may be seeking to distribute the accounting profit of the trust, and therefore there's a difference between what's intended to be distributed versus what the trust deed might require. The definition of income may also link to taxable income, which taxable income may include franking credits. And the ATO's view is that franking credits can't form part of the income to be distributed. Therefore, really critical to understand the exact definition of income of the trust estate and to ensure the quantification of distributions match the trust deed and resolutions. Many resolutions also require consent of parties to be in writing by a specified date. And just in disputes, and a number of disputes that have gone through the courts recently, distributions can be made invalid where those consents or where appropriate authorization can't be evidenced. Examples can include a single director signing a minute that requires a majority of directors under the constitution of the trustee, or a guardian consent being required which isn't obtained for the distribution. In those cases, trust distributions can be invalidated, so they're really important things to consider as part of the trust deed. Finally, trust deed may require distribution to be settled in certain ways. For example, set aside in a separate trust or to be paid by distribution of certain assets. So understanding how to settle distributions is also pretty critical. Now, when you've got multiple trusts in a group, going through this for every single trust and understanding the nuances can be quite difficult. We would always recommend that you have a summary of your trust deed that understands all of these questions, the who, what, when, and where. And how, in terms of trust distributions. Now, we also know that many family groups also look to have trust deeds that are consistent between all the trusts. And so you can consider amending your trust deeds as you create new ones to ensure that all trust deeds are consistent with each other, which can create more simplification when doing trust resolutions at year end, when you've got a number of trusts with a consistent trust deed. So just the key thing we're highlighting here, that it's really critical for your annual distribution process that you do in your checklist, ensure that you've considered the requirements of your trust deed when making trust distributions, as this will be the first place the HO or beneficiaries who are aggrieved will go to invalidate distributions. So I'm going to talk about a number of critical tax considerations for your trust distributions. And in the next few slides, I will talk about the anti-avoidance provisions that the ATO are targeting and focusing on as a part of their reviews. But while going through those processes, sometimes it's easy to forget some of the critical trust tax provisions that you need to comply with before the ATO start targeting the anti-avoidance provisions. So I'll touch on these through this slide and talk to these in a little bit of detail. But again, these need to be part of your annual checklist when you're considering trust distributions. To begin with, when distributing from a trust to a beneficiary, it's really important to understand how a beneficiary is taxed on a distribution. So the trust rules operate such that a beneficiary is taxed on the proportion of taxable income of the trust, and it's based on the proportion of the distributions generally they receive from that trust. So if they receive $10 of income and there's $100 of income, then they'll be taxed on 10% of the taxable income of the trust. Now, the taxable income could be $1 million, and that will mean that they would be taxed on 100,000 in that case. So just understanding how beneficiaries are taxed and the importance of the income of the trust estate is absolutely critical. So once a prima facie tax outcome is determined, we're seeing the ATO consider the compliance of multiple provisions in respect of trust distributions before they get to anti-avoidance provisions. So the first that we want to talk about is just the trust loss provisions. And those provisions can deny distributions to lost trusts or distribution to entities that are taking advantage of deductions when they're not part of what we call the family group and haven't made a family trust election with the same test person. So the ATO are looking at those types of trust distributions and whether appropriate family trust elections have been made. Once a trust has made an election, we're seeing a lot more scrutiny around trust distributions and whether a distribution is being made by the trust to entities that are outside of the family group. Now, when a distribution is made to a party outside the family group, then family trust distribution tax of 47% can apply to those distributions. Now, for these provisions, distributions take on a wider meaning and can include any benefit to a beneficiary. For example, an interest-free loan to a non-family member could get caught within these provisions. And the ATO are absolutely now starting to target family trust distribution tax and family compliance with the family trust election provisions. Where dividends are flowing through a trust, we're seeing again more ATO activity around whether the franking credits are allowed to go through that trust. And again, they're looking at what we call the qualified person rules and whether under those rules, franking credits can be denied. If you've got a discretionary trust, generally you can't get franking credits through a trust unless they're what we call pre-97 shares or unless they've made family trust elections at the trust level. Now, if you've got unit trusts, however, many of the unit trusts can't make a family trust election and need to be a fixed trust. So the ATO are scrutinising these rules, the family trust election provisions and the qualified person rules to determine whether they can deny franking credits that flow otherwise through a trust. Now, finally, where distributions are being made to corporate beneficiaries, the ATO has released new guidance outlining that such distributions, where they're unpaid, will now be considered Division 7A loans. Now, the ATO are more closely scrutinising these arrangements and distributions of corporate beneficiaries, and also looking at how they're being settled and how the unpaid entitlements are being settled. Are they being put on Division 7A loans? They've been put on those loan terms with an appropriate amount of time. Are they being repaid with an appropriate amount of time, such that the money now is falling into the company? So that is obviously a new view that applies this 30 June 2023 and applies to distributions being made. So something that needs to be managed and monitored for distributions. So moving past that, I want to talk about ATO activity and what the ATO has been doing around anti-avoidance provisions and attacking trust distributions through those provisions. And I'm going to talk a little bit more to Section 100A and in the slides to come. But the ATO have been looking to apply the general anti-avoidance provision, which is Part 4A, and they've been looking to apply Section 100A, the reimbursement agreement provisions, where they perceive there to be a tax benefit provided to beneficiaries due to the distributions being made. As you can see from the slide, there's a lot of recent cases, 2022 and 2023 cases with respect to trust distributions, and the ATO has been successful in applying the anti-avoidance provisions in these cases. In the Guardian case, the ATO considered whether distribution to a company that was interposed between the trust and a non-resident resulted in the anti-avoidance provisions. Now, what had happened was by distributing through to a company, the company was taxed at the corporate tax rate of 30%, paid a franked dividend to a non-resident, and therefore there was no more tax to pay because the distribution of franked dividend is not subject to withholding tax. Now, if the distribution went directly to a non-resident without going through the interposed entity, you would have paid tax at the marginal tax rates. So effectively, by distributing to the interposed entity, the taxpayers in that case didn't pay top-up tax. So B Blood's another case that is now on appeal, involved a share buyback arrangement. In that case, in B Blood's case, there were shares that were bought back, and for accounting purposes and for trust law purposes, those were treated as capital amounts to the trust. For tax purposes, the buybacks resulted in dividend components. Dividends were distributed through to the corporate, so there was a lot more taxable dividends that went through the corporate. If they were franked, then obviously no more tax to pay at the corporate level. So in this case, the profits remained in the trust, which would come out effectively tax-free to other beneficiaries in the future, while the taxable income went through to a corporate with tax advantages. Again, in this case, there would be no top-up tax with respect to the accounting profits or the amounts that are going through the trust. In the case of Minerva Financial, that involved a restructure where with a restructure of a corporate group resulted in a separate trust being owned by non-residents. And effectively what they were able to do was isolate interest income in the trust. Interest income is obviously subject to a 10% withholding tax and can be distributed to non-residents without the top-up tax being incurred, but also is a lower tax than 30% that would otherwise be taxed at the corporate level if the amounts were at a corporate level. So these cases demonstrate the flexibility that trusts have and how they can provide tax advantages to beneficiaries. It's just interesting as an observation in this case that they all resulted in permanent tax savings, not timing advantages through to the beneficiaries. And the ATO have targeted all of those permanent tax savings. The ATO won in respect of all three cases. In Guardian, they won on Part 4A. In B Blood, they also won on the anti-avoidance provisions, and in Minerva, they've also won on the Part 4A issues as well. So B Blood's being reheard again from a 100A perspective and a Part 4A perspective. So we're waiting to see what the decision will say on appeal. But the ATO are obviously targeting those cases where permanent tax advantages are being created through the use of trust. So obviously a really high risk category, and the ATO have flagged a lot of these as high risk in their guidance material that they've provided. So what we'll do is we're going to discuss a bit about the ATO's guidance. We're going to talk a bit about the ATO's guidance on Section 100A and provide some guidance to you in respect of some of the items that you'll need to consider for your 30 June 2023 distributions and going forward. Now, while the ATO also looks to apply Part 4A in respects of distributions, we're not going to talk about Part 4A in any detail in the rest of these slides. The ATO have outlined in their decision impact statement or draft and in conversations that they believe that this guidance that I'm to talk to covers the risks around trust distributions, whether they seek to apply 100A or Part 4A. So we believe if you take into account the considerations outlined in their guidance material on Section 100A, that it should otherwise cover both of the anti-avoidance provisions. Now, we have done previous presentations on Section 100A, and I'm not going to go through 100A, the technical provision in any detail, but I'm going to just do a really quick recap so to make sure everyone's aware of what we're talking about. So Section 100A is a specific anti-avoidance provision. It looks at a trust and distributions made by a trust, and it looks at who effectively receives the entitlement to the income, and then they look at whether someone else gets the benefit of that distribution. And then they look at whether the person receiving that benefit essentially would have been a higher tax person and receives a tax advantage by that trust distribution arrangement, which they would call a reimbursement agreement in those cases. An example would just be you distribute to one beneficiary $100, you don't pay them the $100, you provide the $100 to a high tax person and they receive the money, and the lower tax person never receives the distribution. That would be a basic example of when 100A could apply. The consequence of 100A applying is that the trustee is taxed at 47% on that distribution that the ATO seeks to apply it to. And the ATO has an unlimited amendment period, so it can go back as far as it wants to go back in respect of reviewing this provision. So what the ATO have provided is a ruling on Section 100A, and it's provided what we call practical compliance guide on Section 100A, which is contained in PCG 2022/2. Now, these provisions are very complex, and essentially I believe that most taxpayers are going to look to the guidance to work out whether they're going to be in a high risk zone or a low risk zone in respect of their distributions. What I'm going to do on this slide is cover two of the very important low risk zones or green zones with respect to trust distributions, and outline the requirements for those green zones, and also just outline that even though taxpayers may not be strictly within there, that as if you can be as close as possible to these, that hopefully you can be a lower risk taxpayer with respect to 100A. Now, the ATO guidance does have high risk zones with red, what they call red zones. They don't comment in the in-between. So I guess taxpayers will need to do that self-assessment when they don't have a green zone arrangement as to how far they're off and if they've got any elements of high risk. So to start off with, to get into a green zone, the first requirement is that a beneficiary needs to be notified of their entitlement, and the amounts must be reported in their tax return. So as a part of the distribution process going forward, it's recommended post 30 June, once you quantify distributions and know what they are, that there needs to be some evidence that you have notified the beneficiaries of the entitlement. That at least puts you in a position of arguing you're in the green zones per the PCG. Now, the first green zone that is on the left side of this slide is all about distributing to a beneficiary, and then within a time period, which the ATO have as being 2 years, the beneficiary effectively needs to have the benefit of the distribution. Now, I think if we press the button, yeah, so the slide outlines what it means to have a benefit in respect of a distribution. And as you can see, there's a broad category of trying to benefit a beneficiary. You can give them the cash in terms of distribution. You may pay things on their behalf. You may settle liabilities as well. So there's a number of ways that you've highlighted that you can have a beneficiary receive a benefit of the distribution. Again, it needs to be within a 2-year period. On the right side is the second category of green zone, and that is where the trust doesn't pay the beneficiary the money, but retains the money. We call it a trustee retention case. So these can still be acceptable if certain conditions are made, and if the funds are used for one of 3 purposes, which I'll outline in the next slide in a few moments. What has to happen, though, is that the unpaid entitlement, whoever it goes to, needs to be, per the practice statement, on Division 7A terms, even if it's not with a corporate entity, to fall strictly within the green zone. So just before I jump to the next slide, just to give you an example of when the green zone might be used for that first scenario. So if you have, for example, an adult beneficiary and you're looking to distribute an amount to the adult beneficiary, just say it's 100,000. The trustee may consider, for example, at this 30 June, that over the next 12 months, that adult beneficiary, child beneficiary, requires a new car, may have living expenses, may have university fees, may have other things that it needs to pay. It may make a distribution to the beneficiary. Tax may be paid on that distribution. So 100,000 may go to it. There may be tax paid on that amount, reduces the amount of the unpaid distribution. And the remaining amount may be set aside and be used to pay for those legitimate expenses for that beneficiary. So as long as that arrangement can be evidenced and you can evidence that those expenses are being paid on their behalf, that is an arrangement that could potentially fall within green zone number 1. So if I move to the next slide, I'm just going to talk about this green zone number 2, which in a business context or in a family trust context that invests in assets, this is probably going to be a common scenario. So this is a trust retention case. And as you can see from the slide, there's a number of requirements in order to get into the trust retention case, to get strictly in this green zone. And so the first thing is you need to have a trust that is controlled by an individual or their spouse. And so it needs to be controlled by those persons, or you can also look at persons who manage the trust business, and amounts need to go to those persons or entities controlled by those persons. So that's a first criteria to get into this green zone. Secondly, you'll have an amount effectively that hasn't been paid in respect of the distribution, and that needs to be effectively used in one of 3 ways. It can be used in a working capital of the trust. So for their business purposes, it needs to be solely used for that purpose, or it can be used for the acquisition, maintenance, or improvement or investment assets. Now, when I say solely used, it can be used for a combination of working capital and for assets of the trust. But you can't have, for example, 90% used for those purposes and 10% provided as an interest-free loan to an individual. It needs to be used for those purposes. Finally, it can be made to an entity in the group, same family group. And you look at the family trust election provision to work out who would be in the group. And the borrower needs to again use it for either the working capital or for an investment asset purpose, which is listed there as well. So that loan also needs to be put onto 7A terms if you are lending it to that type of entity in order to fall into the green zone 2. So you can see there are very strict rules here to get into this green zone, and it may be difficult to comply with all of those requirements. For example, you may lend it to another entity in the group and you don't strictly have a Division 7A loan agreement, you may have other commercial terms. So you won't be in the green zone in that case. What may happen is you need to do a self-assessment to determine, are your loan terms sufficient enough to say that you're not providing a benefit to another party and it's not being done for tax reasons. Thus, you're not in green zone, but you're not in a red zone. You're in a low risk category. This takes us to the other side of the PCG, which is basically the high risk arrangements. And the ATO flagged what we call 6 red zones or 6 high risk arrangements, which are listed on this screen. The sixth one, which is there, is basically arrangements subject to a taxpayer alert. And there have been a few taxpayer alerts over the times around Section 100A. The most recent one is distributions that have been made to effectively child beneficiaries where they've been applied for certain purposes in respect of living expenses and other things when that should be otherwise be met by the parents of the beneficiary. So there has been a taxpayer alert already issued. The HO may issue more taxpayer alerts. It's really critical to understand what those are and also to make sure that you're not distributing in accordance with any of those taxpayer alerts. What I'll do is I'll move to the next slide because I'll just talk to the six, the red zones, but more from a risk perspective in terms of what those red zones are and essentially what the HO would be looking at or targeting with respect to distributions. So as I mentioned, the HO are looking for distributions made to beneficiaries, but they're also ensuring or looking to make sure that they're receiving the benefit of those distributions. So a key item the HO will be focusing on are distributions to beneficiaries, where those beneficiaries then take those distributions and gift amounts to other people. So they may gift the amount back to the trust. They might forgive the entitlement. They may gift the amount to another family member. Now, to the extent that those results in tax benefits, you could have HO looking to apply Section 100A. There could be real legitimate family reasons why a gifting may occur. There may be no tax benefits with a gift. The distribution may have gone to a top rate taxpayer that's paid 47% that wishes to gift their entitlement to someone else. At the first level, however, if there is a gifting of unpaid entitlements or gifting of distributions that a beneficiary is entitled to receive, that will be in a red zone and a high risk category. So you need to be very careful around those types of arrangements. So as pointed out by those cases that the HO have been targeting, if there are tax preferences on distributions or tax preferred beneficiaries, again, these are ones that are in a high risk zone. So if you're distributing amounts to corporates that have timing differences where there won't be top-up tax paid on those distributions, if you're distributing amounts to non-residents where it goes through a corporate entity or there's certain types of characters of the distribution that provides advantages to non-residents, those could be targeted. Where you're distributing to lost entities, lost companies, lost trusts in the group, and you don't send through the amount of the distribution. So there's a difference in the distribution, or they don't receive the benefit of the distribution. Again, those could be very high risk cases that the HO could target. The HO are looking at circularity of distribution. So circularity is if a trust owns a company, the company pays a dividend to the trust distributes that back down to the company and it circulates. It keeps going round and round. And that might be in that pattern, or it may go through multiple trusts to get back to the same company. The HO are targeting those arrangements. They're also targeting arrangements where, for example, if the trust does own the corporate and the corporate pays a dividend up, it might not go back to the company, it might go out to another person, but the HO are targeting those because they have elements of a circularity because the trust owns the company. And that's what happened in the Guardian case. It wasn't a circular distribution, but that's what triggered the review in Guardians. And we just flag this because you do need to consider it when you're paying off Division 7A loans. It's very common for a company to pay a dividend to a trust, the trust then to distribute that out to pay out the Division 7A loan when it goes through to an individual. So you need to be mindful of these types of distributions and that the HO will be looking at them so that you are complying with 100A and making sure that your distributions are in a low risk category. Just finally, the HO are very much looking at those large timing differences from year to year where you're looking to exploit those differences. And there's many cases where you could have substantial differences between the accounting profit and the taxable income. Many cases come up in the construction industry if you are utilizing the ruling on construction, you may get a lot of deductions up front and taxable income at a later stage, while you may have accounting profit recognized in earlier years. The extent that differences are being exploited, the HO may look to focus on those on a go-forward basis. Things such as the share buyback arrangement that results in difference between the buyback profit and taxable income, again, depending on where those amounts go to, the ATO will be looking at those differences. It's really critical, therefore, if you do have timing differences, that you do look at where those distributions are going to and whether you'll be getting permanent advantages from the distribution choices that are otherwise made. They will result in a higher risk category, and the ATO will be looking at those on a go-forward basis. So in many cases, what we're going to find is that taxpayers will not be able to strictly meet the green zone, and we're very hopeful that trust distributions won't be done in a manner that would strictly meet the red zone. So most taxpayers are going to be in this area where there is no zone that applies to them. What you need to do, therefore, is risk assess how risky the distribution plan is in respect to the guidance the ATO have provided. So we just put down a small checklist here that could be used with respect to your distributions. I'll just talk to that very briefly. So you've got an arrangement, you've got a distribution. It's not technically in the green zone. Critically, the first question is understanding why you're not in the green zone. What are the differences between your arrangement and any arrangement in the green zone? And also considering the red zone risks and how close you are to any of the red zones, even though you may not be technically within that. Secondly, if you're providing a distribution to a beneficiary, are you providing the benefit to that beneficiary? And if not, why not? And how are they ever going to receive those distributions? So that is a critical thing as a part of the assessment. If you are making distributions to a beneficiary and you're not going to pay them the amounts, how are they otherwise being compensated? And if they're not being, how are they receiving benefits? And by way of an example, you may make a distribution to a beneficiary and you might provide a benefit to another entity that beneficiary owns, and indirectly it receives benefits on its behalf through that other indirect arrangement. So you might not be directly providing benefits, but it's worthwhile considering how else they may otherwise be benefiting to try and understand the risk level of the arrangement. You may then need to consider, when you're looking at the provision of the benefits to other parties or who's receiving it, how complex or contrived the arrangement is. And for example, the Guardian case is a perfect one where if you look at the arrangement, they just distribute to a corporate beneficiary that went to a non-resident, and it doesn't look very contrived and doesn't look very complex. However, if they went in a direct manner to the non-resident beneficiary, they would have paid more tax. And so when you look at that, you then need to look at, well, why do you distribute to the corporate? And if the corporate was used for commercial purposes, if it was used for investment purposes, there would have been at least an argument there to suggest that the distribution went to the corporate for other reasons other than the tax reason. So the contrivance of the arrangement needs to be examined or understood where the benefits don't go directly to that beneficiary or what I'd say otherwise high tax person in that arrangement. The last thing to consider is just as a part of the distribution plan, how much tax is being saved by the arrangement and whether the arrangement results in significantly less tax being paid and if it's a permanent advantage in respect of the distribution. Obviously, if there's higher tax benefits being provided and you can't substantiate the reason for the distributions, the distribution pattern or plan is likely to be in a higher risk category. It's really critical, therefore, working with your advisor to sit down and before determining distributions at year end, to go through the process and to understand exactly what the risk rating would be in respect of the distributions. And then understanding if those risk ratings are acceptable before signing off on the distributions at year end. So just to recap on some of the key messages of this presentation. So I just want to reiterate that the trustees of a trust are responsible for the trust distribution decisions that are made. Now, it's not acceptable just to make distributions based on tax estimates and what will become the tax optimal outcome. Trustees do need to consider their beneficiaries, the trust, what it's established for, and also would need to consider the tax consequences of each distribution. So understanding responsibilities of trustees and who they might need to consider. Trustees will need to reach out to advisors, including the legal advisors and tax advisors, and talk to them and understand these responsibilities before coming to year end. It's absolutely evident the ATO's activities are much more in respect of trusts. They're highly under scrutiny. They're coming up in every review of the ATO, in their top 500 review, or in their high risk reviews that they're conducting. So you really do need to actively manage distribution processes and consider risks around anti-avoidance provisions being applied, but also consider risks around whether trust distribution is going to be invalidated by the ATO. The tax liabilities for a trust can be at 47% of the distribution, so that can be quite substantial. So it's absolutely critical that you manage these risks. Now, looking at all these things may result in increased compliance costs around administering trusts and looking after trusts, but unfortunately, that's now inevitable given the heightened ATO scrutiny. Now, you may consider whether you should restructure out of a trust, and it is possible to restructure to roll down into a company, operate through a company. There's a lot more considerations involved in whether you should restructure out of a trust. There could be stamp duty implications. There could be tax payable on a restructure arrangement. Companies are subject to reporting if they meet, if they're a large private company. So they may need to disclose their financial statements to ASIC, have an audit of their financials. So all of these things would need to be considered if you were considering restructuring to a different type of vehicle. However, in many cases, you may find that operating through a company may be a lot simpler, where the company is owned through a trust and all it does is pay dividends to the trust and the trust distributes the dividends to the beneficiary. So it's something that taxpayers should be considering going forward as well. So that concludes our presentation on trust considerations for this 30 June and some of the critical things that we need to be considering. Now, what I'm going to do is I'm just going to check if there's been any questions raised, and I'll look to answer those questions that have been raised. Okay, so just some of the questions. I've got a little bit of time to run through a few questions. So I'll just read the question out and then I'll respond to the question. So one of the questions is how extensive should the inquiries of beneficiaries need to be? So how extensive should the inquiries of beneficiaries they need to be by the trustee? So this is obviously a legal question in respect of the inquiries that the trustee needs to make as a part of the year-end distribution process. However, what we generally understand through our case is that the trustee should make reasonable inquiries and understand who the beneficiaries and the class of beneficiaries are, and at least during the process have consideration of those beneficiaries. Where it's a high risk case, I understand, is where you do have beneficiaries in the family group that have special needs and may not otherwise be able to look after those special needs through their family group or through their investments or their assets. So those are things to take into consideration. You wouldn't need to document your reasons and what you've actually considered. You just need to evidence that you've considered the class of beneficiaries. So the next question that is presented is, can a trustee request modelling on the most tax effective distribution structure? And absolutely. The trustee, as a part of its distribution process, may want to consider who it can distribute to, but also what might be the most tax effective distribution as a part of its considerations. It could do modelling and projections on that and work with their advisors in understanding that. That would be just one of the considerations in respect of distribution planning, distribution processes for 30 June that would be taken into effect. It may actually meet exactly what the trustee is planning to do within the group. But at the end of the day, the trustee will need to take into account all considerations when making its final decision. So another question that has come up has been, what's my position or what's our position on ordinary family dealings? And so this is an interesting question, because Section 100A has a carve out what we call ordinary family dealings. Now, the first comment I'll make on this exclusion that can take you out of Section 100A is that every case that we've seen being brought on by the ATO applies to anti-avoidance provisions. It applies Section 100A which has this carve out for ordinary family dealings. And then it also looks to apply Part 4A. And Part 4A in itself doesn't have an exclusion for ordinary family dealings. It does look at whether there's a tax benefit provided and is effectively the overarching reason for the distribution to give effect to that tax benefit. And so it goes through a number of factors to determine whether the dominant purpose is for the tax benefit. So as a starting point, relying on simply ordinary family dealings can be risky because the HO and Guardian's case, although they weren't successful in applying 100A, were very successful in applying Part 4A. Now, the HO in their guidance material have read down ordinary family dealings, and there's a number of arrangements that we would consider to be for the family that the HO has read down in respect of that not being an ordinary family dealing. Unfortunately, what we have is, though, that the HO have now outlined their view of a restricted view in respect of ordinary family dealings, and essentially it's becoming more difficult to rely on that exception with respect to your distributions to family members where there's tax benefits otherwise being provided to the members. So we obviously understand that the HO have a view. It's questionable whether the HO is correct, but unfortunately the HO will be applying that view in a review. And if you're willing to have a fight with the HO, then obviously taxpayers may take an alternative view. Another question that's come up, and I think there's a few more questions, but I'm going to probably limit it to these next two questions so I can let you all go. So the next question that's come up is, what is the risk attached to trust distributions made in prior years, i.e. prior to 30 June 2022, to beneficiaries who then gifted or forgave this present entitlement? Okay, so obviously the ATO's guidance material, the PCG, applies on a prospective nature and highlights that this could be a red zone risk. And in prior years, there could be trust distributions that were gifted, and the ATO may wish to review those or look at those pre 1 July 2022. So effectively, normally in an ATO review, they will go back 4 years unless there's other factors where they would need to consider it. So the first step would be obviously to look at the prior 4 years to see whether there were any of these arrangements. The second question would be whether this was an ongoing type of arrangement. If it was one-off, it was planned, or if it was recurring year on year. If it was a one-off arrangement, the next part of that question would be essentially whether it was a pre-planned arrangement, i.e. did you plan on distributing and forgiving the debt, or was it a distribution that was made with full intention of repaying, and then subsequently there was a decision to forgive? In that secondary case, there may not be a reimbursement agreement because you need effectively a preordained arrangement to fall into Section 100A. If there is a preordained arrangement, the next question comes down to is whether there were tax benefits associated with that. So if the taxpayer received the distributions, was a higher taxpayer, and then they forgave the distribution for asset protection purposes or gifted those, then it could be a lower risk case. Essentially, there can be some cases that don't fit into any of those categories and could be a higher risk case. And that is something for the trustees to consider and talk to their advisors about, and to understand where they sit on the risk spectrum with respect to those prior arrangements. The last question that I have is, in the green zone scenario 1, you mentioned the benefit need to be passed to the beneficiary in 2 years. Is the 2 years the new time limit to make the UP payment to individual beneficiaries? If so, when does the 2-year calculation start? 30 June, or when the tax return is lodged? So yes, the 2-year period is a new rule in terms of what the HO have established in terms of the payment requirements. Now, my understanding is that 2 years is from the 1 July period, but we can confirm that, and we can respond in our email to everyone in terms of the exact requirements of the 2-year date. Effectively, all the HO is requiring is that you make sure that you make that payment and settle that benefit to beneficiaries within that 2-year period. So yes, it is effectively the new timing requirement for trust distribution. So look, I just wanted to thank again everyone for attending today. If you have any other questions, please feel free to send your questions to us. Be happy to talk to you and respond to your specific questions. You can obtain more information from our website or contacting your Pitcher Partners contact that you otherwise have. You can also watch our Pitcher Partners YouTube channel for our past content. We do have presentations on Section 100A and other presentations on trusts and Division 7A that might be useful for you in answering a number of questions that we went through this presentation. For more information to be in the know, just please check out our Pitcher Partners website, LinkedIn, and our YouTube channel. Again, thank you very much for attending our session today and have a nice day. Thank you.